All right. I am here with Jim Stevenson, the founder and CEO of Bletchley Group. How's it going, Jim?
I'm good, thanks, Steve. How are you?
Doing great. Doing great. I'd love to get into the strategy, but before we do, let's talk a little bit about how you got started in business and in strategic advising.
Okay, I can take up your whole day talking about that, but I'll try and keep it short for you. I worked in construction years and years and years ago in Scotland and didn't particularly like it, but the training it gave me was phenomenal. So I created Bletchley Group 25 years ago now. And it was with the sole purpose that companies were getting into understanding what technology was but didn't quite know how to use it. But since then, we've evolved, so we're much more of a wider ranging strategic advisory company. So we do a lot of strategic advisory, a lot of transformation work, fundraising, and what we're here to talk about, M&A and exiting and stuff like that. And that's very much where the companies come from. And I got into it because I like it, to be honest. I'm one of those sad people that enjoys what they do, so I kind of do it whether I got paid for it or not, but just don't tell any of my clients that.
Nice. Nice. You like what you do. That's pretty key.
Yeah.
So this episode's pretty unique in that we're going to be talking about some strategy, and I want to dig into some mistakes that you've seen over the years that founders have made when they're going through exits, because I find the kind of gold is in the mistakes that people
Yes.
make and how you can learn the fastest. So before we get there, though, let's kind of dig into some of the things people can do to be prepared when they're operating their business. It's going through the life cycle, kind of through the motions. It gets to a plateau. How can people begin to prepare and the initial steps that they need to kind of get in line?
I can answer this in like 5 seconds, or I can spend more time on it. The 5 second answer: run a good, solid business. If you've got a good, solid business, your business fundamentals are there, you're pretty much fine. You're doing what someone will want to buy. More specifically, though, it's about making your business attractive to someone to buy, recognizing that they're going to buy it for a reason. If your business is perfect and you're valuing it at the very top end, an investor can't come in and achieve anything. They're not going to be able to do something to take it to the next level because you've been there and done it. So it's recognizing that your strategy has to give an investor coming in a level of growth. So understanding that they may want to just come in and run it the way you've been doing it and get a nice paycheck. Your exit strategy may be that you want to sell to a strategic, in which case they want to add you onto their existing portfolio or something like that. So understand where they're coming from. But from real practical things, it's about having a vision. It's about having a strategy that gets you there. It's about doing things like diversifying your client portfolio. No one wants to come in and know that 60% of your revenue is coming from one or two clients, or all of your revenue is coming from Florida. They want diversity. They want to know that your business is strong, and if there's something happens in Florida or LA or New York, the business is, the fundamentals of the business are still going to be there. So having that diversity of the clients, having that diversity of your revenue streams is key. Having a vision to where you're going. Beyond that is having your system set up, being really efficient. It's having some IP if you've got an IP style of business. And then the one that I love is understanding where your risks are. Because if you understand where they are, then you can deal with them. If you don't know where they are, then they're always going to be a surprise. But if you understand where your risks are, I don't have enough diversity, I don't have enough revenue streams, I'm locked into one supplier in my supply chain and there somewhere. Those are always the things that you want to be looking at. So there's a multitude of these things depending on which part of the cycle you're at. But like I said at the start, it comes down to if you've got good basic business fundamentals in place, you're pretty much 90% of the way there.
I like because it's kind of counterintuitive with highlighting risks when
Oh,
people
I
are
love.
coming to the table, I guess, when they're saying kind of the pitfalls of their business. And
Yeah.
I think a lot of times people see that as almost discounting themselves, but in reality, it's sort of empowering the buyer in a way to say, like, these are the kind of the blind spots that you could potentially see in this, whether it's now or in the future. And I think that's really valuable.
I love looking at the risk aspect, and it's something I think a lot of Americans, without dissing your nation, it's something that a lot of Americans miss because it's such a positive nation. America always looks at the positives. It looks at how are we going forward, and there's always that positivity coming through. But I think if you look at the negative, you look at the risks that you have in your business. One, if you don't notice it, you can't deal with it. So identifying them allows you to deal with them early. But the other aspect of it is if you are going through an exit, you don't want to spend 4 months going through due diligence and then a negative suddenly pops up that you weren't aware of that kills the deal. So if you are aware of it, then you can address it early as part of the exit strategy, and you can say, yeah, we know it's there. This is our strategy for dealing with it, and it becomes a non-issue. Whereas it surprises you and it surprises the potential buyer, then it does become a big issue. And I have seen a lot of deals fall because a risk to the business wasn't recognised, wasn't dealt with, it wasn't called out early enough.
Mm-hmm. Mm-hmm. And that's a good segue into valuation. Like, what are the key levers that you've seen people pull to drive up valuation when they're negotiating, and in what part of the process?
When we get into the negotiation, I'm huge for transparency. And I think the more transparent you are, the better in the business fundamentals where you are. Like I say, I would prefer to know within a week that there's a problem and we can address it, rather than getting all the way down the process and the deal falls apart. But for the valuation specifically, there's 2 or 3 things. Everyone pretty much focuses on EBITDA because every business today is kind of valued on a multiple of your EBITDA. Discounted cash flow and things like that tends not to be as common. So get your EBITDA, make it sweet, get it as big as you can based on where you are. Recognise that there'll always be some buybacks and adjustments to your EBITDA that you need to add in there. So be aware of them before you start the process, so that you're being practical and understanding those issues. But the one that most people forget is people buy into your business because of the vision that you have for it and how that vision aligns with what they want to achieve or their existing portfolio. So make sure that you've got a strong story to tell. This is where we are, this is where we've come from, this is how we've got here, this is what the business is, but this is what the future could hold, and this is their plan to get there. So that it's like, I have a partner in London who hates me using this analogy, but it's a really good one. If you're selling your house, and literally you've had a kids' party yesterday, and you've got buyers coming to it today, they're not coming in to see your house in the best state that it possibly can be. So if you're selling your house, get your curb appeal up, do a bit of painting, tidy up, move some furniture around, let a buyer see the potential of them moving into that house and living there. And it's the same for your business. Let a buyer see them owning your business, where it could go, how they could make money from it, how they would leverage it. And that's all about your storytelling, your strategy, where you're trying to get to. And then underpinning that is your EBITDA number of actually the business has got solid foundations, it's making money, it's got profitability, I can see where we're going next. And so it plays off both of those.
Mm-hmm. Mm-hmm. And let's get into the mistakes. I want to talk about some of the issues that you've seen come up, but specifically, I'm curious about what founders have done that has killed deals, that maybe if they wouldn't have done it, that it wouldn't have fallen apart.
I mean, there's probably a list of like 10,000 things that have happened, but I'll stick to the big ones that I see. The big ones that I see are waiting too long. There's never a good time to sell your business. There's only now. And everyone's like, I'll wait 6 months, I'll wait 12 months, I'll kind of keep going. And that's fine. And I have no problem with someone waiting 6 months, waiting 12 months, if they have an active plan to improve the business during that time. If you're just hoping that the world is going to change and the world is going to get better, so you'll hang on for 6 months so that a problem you've got will go away or the market will suddenly pick up, then it's just a fool's errand. It never works that way. So the best thing you can do is start now and see what the market's doing, see how things are working, see who would be interested in acquiring your business. You can always say no, but it's very difficult to say yes if you don't have a buyer on the hook. So get out to the market as soon as you can, but do it smartly. I mean, don't just kind of phone someone tomorrow and say, do you want to buy my business? Prepare as much as you can, but there's never the perfect time. There's only now. There's good. The big one that everyone has a problem with is overvaluation. Everyone puts their blood, sweat and tears into their business and think that I've been working on this for 10 years. It's got to be worth 35 million now. And it's like, well, it's kind of, the valuation is not what you think it's worth. The valuation is what someone's willing to pay for it. And I've seen so many deals falter because the seller's expectation, not just in the valuation, but the valuation is a big part of it, but also in the deal structure. I have one whereby the guy wants to sell his business, but he doesn't kind of want to sell it. So he wants to sell a majority of it, but still run it because he thinks he can improve it in the next 3 years. But he does want to take several million off the table during that period. And it's kind of like, okay, so I think what you're asking for is to take money off the table, sell a percentage of it, keep running it as part of your earnout, and then kind of have a bigger exit. But the lack of clarity in what he's trying to achieve as his exit is making it near on impossible to give him the best advice because he doesn't quite know what he's aiming for. And then on top of that, he's given himself a 16x multiple when the investors I'm talking about are kind of suggesting maybe 6 to 8 multiple. And it's kind of, I mean, it just becomes really difficult to sell his business. And he's been working on it for 15, 20 years, so I understand his passion. But it's kind of like, well, if you want to keep running it, then don't talk about selling it. Keep running it and happily kind of help you do that. So that overvaluation, over expectation is a really big thing. The other one, as I said earlier on, dependency on specific clients, having 2 or 3 key clients. It's great to have big clients that buy into you, but if you're over dependent on them, that's a big issue. Founder dependence, being too reliant on the founder. In some cases, never getting away from founder sales, which is a challenge. As your business grows, you need to be able to hand over the reins and create a playbook for selling what you do and allow others to kind of follow in your footsteps to sell. So that whole kind of founder dependence in there, as well as running the business, having a succession plan. So there's lots of kind of mistakes that people can make going through as they get there. But again, going back to the very first statement, if you're running a good, solid business with basic fundamentals, then as the founder, you should be running the business, working on the business, not in the business. So it goes back to those key fundamentals of a business. Are you the business or are you running a business? And if you're running a business, then you have someone that's going to be able to do your sales if you're not there. You can go on vacation for a week or two and actually the business isn't impacted. You will have a reasonable expectation of what the business is worth because you've got that kind of real world expectation of how the business is operating, where the pluses are, where the negatives are.
Mm-hmm. Mm-hmm. And when it comes to valuation, overvaluation, I guess, when you bring that up, I've talked to so many different people about valuation. What's your take on I guess how to derive it? Every business is different, of course, but in your experience, you've mentioned a couple different metrics like EBITDA. What would you suggest as the first steps when people are going in and valuing their business? What are the things that they need to take into account, and how do you see the most successful sort of multiples come out when people are valuing their business?
I mean, the multiple is a really easy metric, and that's why so many people use it. Generally, the multiple goes on sector. So whichever sector you're in, if you're in a low-value service-based business, it's not very automated, you'll be a much lower multiple, maybe down as far as 3 or 4. Assuming you've got a reasonable turnover. I think if you've got a low turnover, then any valuation is difficult. Up to marketing services businesses, 6 to 8, to high-tech businesses, 15. If you're in the world of AI, then God knows how you value that business. It's 30 times multiple or something ridiculous. So you've got a baseline with what your competitors are doing. And it's always that comparison, which is the fundamental key to it. These guys are doing well, but we're doing better. So they've got a 16 multiple, I should be 17 or 18. These guys have got a better client diversification. So I'm going to kind of take a percent off or whatever it is. So it's taking that realistic view of how you are with your competitors. And then it is testing the market, because there's no way to kind of predict this. It's give yourself something that is realistic, set a mindset that says you want to sell your business. That's why you're here. That's why you're going through this process. Absolutely set a bottom line. I'm not going to sell it for X. It has to be above that number, but keep that number low. Keep that number flexible. The other thing that I like doing when you get into these deals is, yes, value your business realistically based on your competitors, based on where you are, but also think about the creativity in the deal making. It's very often worth your while to sell your business to someone that's in your industry, because they're actually going to quadruple your revenue in 3 years' time that you could never achieve yourself. So have 35% of something that is 4 times bigger rather than having 80% of something that is much smaller. So look at those kind of metrics and see how you can build those into your valuation, so that your value isn't just what you sell your business for. It's the totality of the package that you can get by selling it and who you're selling it to.
And let's talk about timing. I think we've dug into preparedness and some mistakes, but I think the biggest and sort of close to impossible metric to measure is timing. But what have you seen in your experience over the years with when the right time to sell is?
The right time to sell is not next week. And the number of people that I have coming to me and saying, I'm fed up with the business, my family's changed, I want to go away and retire early, I want to sell the business, and it's like, yeah, I'm looking to kind of get out, I want to be in the Caribbean in March. And it's like, that's great, I want to be in the Caribbean in March as well, but the reality is, if you want to sell your business that quickly, you're going to have to give up something, and that's probably the valuation. So the timing is always expect that. I think I saw something that said currently fundraising can take anywhere from 12 to 15 months depending on your business. I think if you're OpenAI, then fundraising is a week, but for everyone else it takes much longer. So selling your business is similar. It's a case of, if you want the top dollar, it will take you longer to find the right people to do that, people who are willing to see what the business is like. Matching that is kind of like a matchmaking game of who's the best person. And that always takes a bit longer. And those people that want to buy your business, they also want to do some due diligence. They want to make sure that your business is the right business for them. So take that into account when you're getting your timing done. It's not going to happen tomorrow. It could be 6 months. It could be 12 months. And then once you've sold your business, you're going to have an earnout period. And if you're lucky, your earnout period will be in a couple of years, might be 3 years. So in total, from making the decision to sell your business, it could be 12 months by the time you find a buyer and 2 years to do your earnout. So you're 3 years still involved in your business before you get out of your business. So keep that in mind. It's not a quick process. And if you want it to be a quick process, you're going to give up an awful lot in your valuation.
And when it comes to large corporations versus startups, one of the crazy parts about this is a lot of times people look to valuations of $100 million, $200 million companies, billion-dollar companies, and some of these smaller, I guess where you could say the average exit size isn't in these large ones, but yet we benchmark to those on across the board.
Yeah.
So, in your experience, how does that play into the conversation? Do a lot of people use that still, where it's industry multiple, like we were talking about a minute ago, on those bigger companies, or are people getting more kind of like real estate comps for multiples on smaller companies in different sectors?
Yeah, I think it goes down into, I'm trying to think of the nice way of saying this, how realistic the founder is that's exiting, or the business owner that's exiting. I think if you've got a reasonable head on your shoulders, you'll recognise that you can't compare yourself to a publicly traded $1 billion company because you're turning over 25 million. The comp is just not there. The security is not there. The diversification is not there. The scale's not there. The risk profile is different. The type of investor you're going to get is fundamentally different. You just cannot do that. So it has to then go back down into the, like you say, the real estate comps. What did your neighbour sell for? Similar house, similar area, similar, and get those comparisons as close as you possibly can. But it comes down to that mindset. If you want to actually have a reasonable chance of exiting in a reasonable time frame, you've got to be reasonable with what you're expecting. And that is, you're comparing yourself with like companies. And there's very few companies that aren't like. I have worked with some where the company had 3 or 4 different divisions. So you split the company down into those divisions and you value each of them separately because they are different to each other. And there is no one company with those 4 divisions in the way that they've set it up. But you can always break it down. And a lot of it is not about being right. It's about having a process to get to why you got to that valuation. I got to the valuation based on these metrics, these comparisons, these assumptions, and that's what I think the company's worth. And if you can defend it, then you can go out to the market and defend a valuation that says this company's worth X. If it's, I put 15 years into this business and I'm not selling it below 25 million, then you can't defend that. That's an emotional valuation rather than a logical, well thought through, reasoned one. And there's always negotiation. And that's kind of where the reasoning comes in. If you can defend your reasoning, then you can defend your valuation.
Mm-hmm. Yeah. Defend the reasoning, defend the valuation. And I remember a few episodes ago, I talked about how like setting a expectation and a benchmark during first conversations with potential buyers and then blowing past that goal while you're in the process, I've heard is almost a way to like just reset expectations while you're in the process, which I thought was a really creative take.
Yeah.
Another guest had, just because you do whatever you can to basically show that you and the company and the team can surpass goals that are set, not just projections and all these things just based on the spreadsheets.
Completely. It's setting those expectations and running a good quality business. I had one 4 months ago, where the company was doing great. Its revenue was up 30% year on year. It was a really cool company. It was in a really good sector. I found them an amazing buyer that was in the same sector. You could just see that the partnership is the perfect partnership, but they had a really terrible Q3. So, and the buyer's kind of going, well, hang on, I want to see whether they pick it back up again or not. And it's like, oh man, if you'd kind of kept that going, but the world changed, the environment changed. So it's always that kind of meeting the targets that you set yourself shows that you're capable of achieving it. You've got a good quality team. Mm-hmm. You just need one thing to happen that doesn't do that, and the opposite's true. It's like, well, let's speak again next quarter. Let's see how this quarter goes, and then we'll pick the conversation up. And that's just life. Mm-hmm. It's the thing that personally, it's one of the things that I find frustrating. Because if a client is telling me and keeping me up to date on how they're trading and what they're doing, you can tell an investor that they've had a bad quarter, but they've got a plan to come back, and you can manage those expectations. Without it, it's kind of blind, and everyone gets a bit of a shock, and no one wants a shock when they're in this kind of deal making process.
Yeah, agreed. So that takes us to the finale. Knowing what you know now, what would you tell Jim 10 years ago?
I think it's probably, I'm not sure I'm allowed to advertise on your podcast, but it's the Nike thing, just do it. I think so many people procrastinate, so many people overthink, so many people want to get everything perfect, so many people kind of want to have this whole thing packaged up, and once I get it all perfect, it'll all happen tomorrow and it'll be great. And Very rarely works that way. I think it's just do it. Once you're in the market, you can see what your company's truly worth. You can see how people are reacting to it. Once you're actually out there improving it and going through a strategy to get your valuation up and present your company in the best way possible, it's seeing how these things happen that allows you to react and improve. Whereas if you just think about it, then you're not really improving anything. You're just going through a thought process and procrastinating. And it's very common. I'm not criticising people for doing it because I do it as well. But it's the just do it. Just go out there and do it.
Yeah.
Make it
Nice. The good old Nike slogan.
happen. Exactly.
Well, cool. What are you working on now, and where can people learn more?
My website is bletchleygroup.com. And it's or the other place to find me, and probably the best place to find me, is LinkedIn. So you'll find a face similar to this one on a profile with Jim Stevenson attached to it. I've got several things on the go at the moment, everything from $1 million raise to, I think the biggest thing that's on the go is 150 million investment, and a few strategic advisory pieces. So yes, life is busy. I like busy. I like being occupied. I think I had a girlfriend about 20 years ago who told me that I get bored easily and I like to build things. So if you're in the market for building something and you need some help, then I'm always available to have a coffee and a chat.
Well said. Very nice. Very nice. Well, those are all the questions I have for you. Wherever you guys are listening on iTunes or Spotify, the links that Jim mentioned will be in the show notes. But thank you so much for coming on, Jim.
Brilliant. Thanks, Steve. It was great. It was great chatting.